Welcome to Wednesday's Targets in Focus. I'm Elaine Stenson, and today I'm going to be looking at the US dollar crosses with emerging markets. Emerging markets are coming out of a rough week and are starting off this week on a softer note as well. I'm joined on the line now by Kevin Yan from FXDD in New York. Kevin, the Indian rupee has continued weakening today against the US dollar despite Reserve Bank of India Governor's observation that India has enough in foreign exchange reserves to protect the country from a repeat of the 1991 crisis. Kevin, what are your 1, 6 and 12-month projections for this pair?
The Indian rupee weakened over 3% in the last week of trading, and the 3-day moving average crossed above the 30, telling us that the short-term sentiment of the market is clearly in favor of dollar strength versus longer-term averages. So there's a couple of factors that contribute to the weakness. Number one being the return of state-run oil refineries that hedge exposure by purchasing dollars through the open market. Number two, the potential tapering of the U.S., which is a driver of dollar strength against all major NEM currencies, including the rupee. Number three, the recent rate cut out of the ECB led to an increase in international demand for U.S. dollars. So technically speaking, we're up 16% in the past 12 months, and I see dollar strength as a main trend continuing into next year. As a short-term projection, I see rupee breaking back above the August highs at 69. And 6 to 12 months out, I think that since 69 is the historical highs, I would have to go with the recent rate of appreciation and say that 73 to 75 is going to be the price range towards the end of next year.
The US dollar-Mexican peso pair used to be synonymous with the S&P 500, but as can be seen in recent months, the paths of stocks and the currency pair have diverged. What are your forecasts for the next 12 months for the dollar-peso pair?
We're currently trading around the 38.2 Fibonacci level if you measure the lows of August 2008, when $1 was valued around 10 pesos, and the highs of 2009 when dollar MEX was trading above 50.5. The central bank cut rates back in October by 25 basis points, down to 3.5%. So that takes us to historical lows. And despite them saying that further easing is undesirable, it's something that's generally been data dependent. Fundamentally speaking, you look at consumer confidence, inflation figures, everything is pointing towards the downside. So in their last statement, the central bank pointed out an inflation target of 3%, with 4% being the upper limit. So if we continue towards that direction, it's very likely that we'll see the central bank to act again on potential rate cuts. So on this basis alone, especially given the fact that the U.S. is very likely at some point to increase rates, I would be bullish on dollar MEX with a target of 13.5 in the short to midterm, while looking for a breakout to the upside to 14.5 and possibly even the 15 handle in the extension.
Emerging market currencies have traded in several distinct phases this year. After a strong start of the year, the emerging market rally was derailed by Bernanke's tapering speech in May. Emerging markets sold off for much of the summer. This pair peaked on August 21st and then bottomed on October 18th. What are your forecasts for the dollar Brazilian real pair?
Interest rates in Brazil have steadily climbed since the beginning of this year, and the central bank has increased rates by 50 basis points every month since May, from 7.5% to 9.5% now. So the gradual increase in rates lowered borrowing demands, which in turn drove the real's value lower. Meanwhile, the international demand for dollars, along with its historical low rates, have created even more momentum for the dollar real's move to the upside. We're up close to 13% year-to-date thus far, and I see a lot more upside potential in the coming months. So in the short term, I think we'll see the pair trade back to the highs of its 52-week range, which is right below 2.5. If we do get there, I think the central bank may step in and provide some support for the real. But generally, these interventions are short-lived. So in the 6 to 12-month time frame, I think we'll see price action break above 2.6 level as a midterm target and then head towards 2.8 as a longer-term extension.
Kevin, thank you for joining me on the line today. And that's all from Targets in Focus today, but Monica Gibson will be back with more on Friday, so do check back for that. Bye for now.